Let me start by explaining the current silver market situation, because if you understand what's happening right now, you'll see why this decision makes so much sense. Silver just wrapped up 2025 with a gain of nearly 150%, closing the year at record highs. We're talking about the strongest annual performance since the late 1970s, and here we are in January 2026, already up another 20% year to date. Silver recently touched above $90 per ounce, and we've even seen it spike to $95. Think about that for a second. Just a year ago, silver was trading under $30 an ounce. But here's what most people don't understand. This rally isn't some temporary speculation-driven pump. The fundamentals driving silver right now are absolutely massive, and they're structural, not cyclical. The silver market has been in deficit for 5 consecutive years. That means global demand has exceeded supply every single year since 2021. We're talking about cumulative shortfalls above 796 million ounces. In 2025 alone, the deficit was somewhere between 149 and 215 million ounces, which is about 15% of total annual output. And analysts at UBS are projecting an even larger deficit of 293 million ounces for 2026. Now let me tell you about something that just changed the game completely. On January 1st, 2026, China implemented new export restrictions on refined silver. This isn't just some administrative policy change. China controls between 60 and 70% of the world's refined silver supply. They're the gatekeeper. And now they're requiring government licenses for silver exports, and only large, state-approved companies with annual production over 80 tons and credit lines exceeding $30 million can export. This has effectively locked out hundreds of smaller and mid-sized exporters who've been key suppliers to global markets. Think about what this means. China exported 4,600 tons of silver in the first 11 months of 2025, while importing only 220 tons. They're a massive net exporter, and now they're choking off that supply. Elon Musk himself warned about this, saying silver is needed in many industrial processes, and these restrictions could pose serious problems. The market is already feeling this. Silver lease rates in London have spiked to 8 to 9%. Physical inventory at places like the COMEX have been drawing down dramatically, and we're seeing unprecedented tightness in deliverable supplies. And the demand side? It's absolutely explosive. Over half of silver demand comes from industrial uses, and that demand is accelerating. Solar panel manufacturing alone has quadrupled since 2015 and requires 100,000 ounces per gigawatt. Electric vehicle production, AI data centers, advanced semiconductors, electronics manufacturing, they all need silver. Silver has the highest electrical conductivity of any metal. You can't replace it easily in most applications. The green energy transition and the AI revolution are both massively silver intensive, and they're both accelerating at the same time. So we have structural deficits, China choking off supply, and industrial demand going through the roof. Investment demand is also picking up. ETF inflows turned positive in 2025 after years of outflows, and institutional allocations to silver are rising. Some analysts are putting out price forecasts that honestly sound crazy until you look at the fundamentals. The LBMA's 2026 forecast survey has analysts projecting an average annual silver price of nearly $80, with some predictions going as high as $165 to $175, and even one forecast at $375. Now, I'm not saying we're definitely hitting those numbers, but these aren't random guesses. These are professional analysts looking at the supply-demand equation and recognizing that silver is fundamentally repricing. So if I'm so bullish on silver, why did I sell 80% of my physical holdings? This is where understanding leverage comes in. When you own physical silver, you get exactly the price movement of silver. If silver goes up 50%, your stack goes up 50%. That's it. But when you own the right mining stocks, you get operational leverage. Let me explain how this works. Silver is currently trading around $88 to $92 per ounce. The average all-in sustaining cost for silver miners is somewhere in the $15 to $20 per ounce range. Some are even lower. That means these companies are making $70 to $75 in profit per ounce. Now imagine silver goes to $100. That's only a 14% increase from current levels. But that miner's profit doesn't go from $75 to $85 per ounce. It goes from $75 to $95 per ounce. That's a 27% increase in margins. And since stock prices often follow earnings and cash flow, the stock can move much more than the underlying metal. This is called operational leverage, and it typically gives you 2 to 3 times the movement of the metal price once you're above break-even costs. In a bull market for silver, properly selected mining stocks can dramatically outperform the physical metal. I've seen estimates that mining stocks can deliver 127% average NAV multiple expansion during producer transitions and major bull markets. That kind of upside simply isn't available with physical silver sitting in a safe. Now let me be clear about the risks, because mining stocks aren't just leveraged silver exposure. They come with operational risks that physical silver doesn't have. Mines can have technical problems. Costs can overrun. Management teams can make bad decisions. Countries can change regulations or taxes. There's execution risk, geopolitical risk, and company-specific risk. This is why I didn't put 100% into mining stocks. I kept 20% of my physical silver because I believe in having that foundation, that insurance policy that can't be mismanaged or shut down. But if you're willing to take on the additional risk, and if you do your homework on which companies to invest in, the upside potential is extraordinary. So let me walk you through the types of mining stocks I'm focusing on and why I picked them. First, I wanted pure-play silver producers. These are companies that get the majority of their revenue from silver, not just silver as a byproduct of gold or copper mining. First, Majestic Silver gets 57% of its revenue from silver, making it one of the purest plays in the sector. They operate multiple mines in Mexico, which is the world's largest silver producer. They also completed a major acquisition in early 2025, buying Gatos Silver and gaining a 70% interest in the Cerro Los Gatos mine. This is a high-quality, long-life operation. First Majestic also owns a minting facility and has a strong balance sheet with the ability to invest in exploration and new development. The stock returned 287% over the past year. These aren't small moves. Pan American Silver is another major player I'm looking at. They bill themselves as the world's premier silver mining company, and they've grown through strategic acquisitions. In 2025, they closed a $2.1 billion deal to buy MAG Silver, giving them a stake in the large-scale, high-grade Juanipio silver mine. They have mines across Mexico, Peru, and North America, giving them geographic diversification. They've got substantial reserves, 452 million ounces of silver and 6.3 million ounces of gold. They generate free cash flow, and they return cash to shareholders through dividends and buybacks. That combination of production, growth projects, and financial strength makes them a core holding. Then there's Wheaton Precious Metals, which is different because they're a streaming company, not a traditional miner. Instead of operating mines themselves, they provide upfront capital to mining companies in exchange for the right to purchase silver and gold at reduced prices. This model reduces direct operational risk because they're not the ones running the mines, but it gives them diversified exposure to multiple producing assets. Wheaton is the largest company on my list by market cap at roughly $59 billion, and they've been extremely successful with this business model. It's a way to get leveraged silver exposure with less day-to-day operational risk. I'm also looking at Hecla Mining, which is the largest US-based primary silver producer. They have operations in Alaska, Idaho, Nevada, and Quebec. They're producing around 16 to 17 million ounces of silver annually, and they have a strong track record of reserve replacement. What I really like about Hecla is their exploration success. They've made significant high-grade discoveries, including finding visible gold and high-grade intersections at their Midas project in Nevada and their Keno Hill operations. These discoveries can dramatically increase the company's production profile and resource base over time. Fresnillo is the world's largest primary silver producer and operates extensive high-efficiency mines throughout Mexico. They're advancing multiple projects to boost production between 2026 and 2030, and they recently made a strategic move into Canada by acquiring Probe Gold, which owns the Novador Gold Project. That project has the potential to produce over 200,000 ounces of gold annually for more than 10 years. Fresnillo combines high-quality assets, ample mineral resources, competitive margins, and a disciplined development approach. Now, all of those are larger, more established producers, but I'm also allocating a portion to some smaller, higher-risk, higher-reward names. Companies like Silvercrest Metals, which operates the Las Chispas mine in Mexico. It's a high-grade, low-cost operation that's generating significant free cash flow, and they have a district-scale land package with exploration potential. Or Dolly Varden Silver in British Columbia's Golden Triangle, which has a high-grade project and is backed by Eric Sprott. These junior miners and developers can deliver outsized returns if they execute, but they're definitely higher risk. The key is building a diversified portfolio across different types of companies, some large-cap producers for stability and dividends, some mid-tier growth companies expanding production, some streamers for lower operational risk, and a small allocation to high-potential juniors for that lottery ticket upside. This isn't about putting all your eggs in one basket. It's about creating a portfolio that captures the full spectrum of leverage to silver's bull market. Now, I want to address something important. A lot of people ask, why not just buy a silver ETF or silver mining ETF instead of individual stocks? There are pros and cons. A silver ETF like SLV or SIVR tracks the price of physical silver, so you get the metal's performance without storage costs or the hassle of selling physical. That's convenient, and it's definitely better than owning nothing, but you're not getting the operational leverage I talked about. You're just tracking silver's price, and you're paying an annual expense ratio for that. Silver mining ETFs like SIL or SILJ give you diversified exposure to multiple mining companies, which reduces single stock risk. That's a valid approach, especially if you don't want to do the research on individual companies, but you're also stuck with whatever holdings that ETF manager picks, some of which might be terrible companies, and you're again paying that expense ratio. I prefer to pick individual stocks because I can focus on the best companies, the ones with the strongest balance sheets, the best management teams, the highest grade deposits, and the most exploration upside. That takes more work, but I believe it delivers better returns. Let me talk about timing because people always ask if now is the right time to make this move. Look, I can't tell you what's going to happen tomorrow or next week. Silver could pull back from these levels. We've already seen some profit taking after silver hit those record highs above $90. Short-term volatility is guaranteed, but I'm not making short-term trades here. I'm positioning for a multi-year bull market driven by structural fundamentals that aren't going away. The deficit isn't going to magically fix itself. Mine supply can't respond quickly. It takes years to bring new silver mines online, and there aren't many major new projects in the pipeline. China's export restrictions aren't going away. The industrial demand from solar, EVs, and AI isn't going away. In fact, it's accelerating, and investment demand is just starting to wake up. We're still in the early innings of institutional and retail investors recognizing what's happening in silver. If you look at the gold-silver ratio, silver is still historically cheap relative to gold. That ratio recently came down to around 50, which is better than it was, but it's still above the long-term average. Silver has room to continue outperforming gold. And if silver mining stocks historically deliver 2 to 3 times the performance of the metal in a bull market, and if we're genuinely in the early stages of a major move, then I want to be positioned in the miners, not just the metal. Some analysts are saying we could see silver at $100, $150, even higher by the end of 2026 or into 2027. I'm not going to make specific price predictions because nobody knows for sure, but I will say this. The setup right now reminds me of previous major bull markets in commodities, where everyone said the prices were too high right before they went exponentially higher. In 1979, silver gained 470%. We're not there yet, not even close. I'm not saying we're going to replicate that exactly, but the point is, in a true supply crisis with explosive demand, prices can move in ways that seem impossible until they happen. So what about the 20% of physical silver I kept? Why not go 100% into mining stocks if I'm so confident? 2 reasons. First, diversification. I never want all my wealth in one type of asset, no matter how bullish I am. Physical silver is insurance. It's the foundation. It has no counterparty risk. It can't go bankrupt. And in a true currency crisis or financial system meltdown, it's the ultimate safe haven. I want that base layer. Second, if I'm wrong about the mining stocks, if there's a major market crash, or if these specific companies I picked have serious operational problems, I still have my physical silver. It will move with the silver price, and in a worst-case scenario for the financial system, it's the one thing I know I can rely on. That 20% is my sleep-well-at-night position. But the 80% I moved into mining stocks, that's my wealth-building position. That's where I believe the real opportunity is. If silver goes from $90 to $120, that's a 33% gain. My physical silver goes up 33%. But well-managed silver miners with strong balance sheets and low costs could see their stock prices double or triple. That's not guaranteed, but the potential is there, and it's backed by real operational leverage, not speculation. Let me give you some things to watch going forward. First, keep an eye on China's actual export numbers. We know they've implemented the restrictions, but how much silver actually flows out in the coming months will tell us how tight the market really gets. If exports drop by 50% or more, we could see annual deficits exceeding 5,000 tons, which would be absolutely massive. Second, watch industrial demand data, especially from the solar and EV sectors. If those industries continue growing at current rates, silver consumption will keep accelerating. Third, watch for any major new mine supply coming online. If there aren't significant new projects starting production, the supply side stays constrained. Fourth, watch the COMEX and LBMA inventory levels. If those continue drawing down and lease rates stay elevated, that signals real physical tightness. And finally, watch how the mining companies execute. Are they hitting production targets? Are they keeping costs under control? Are they making smart capital allocation decisions? The companies that execute well will be the ones that deliver those outsized returns. The ones that stumble will underperform. That's why ongoing research and portfolio management matter. I also want to address a question I know some of you are thinking. What if silver peaks and this whole bull market is over by the time I get positioned? Look, that's always a risk with any investment. But based on everything I've studied, we're not at the end of this move. We're at the beginning. The LBMA survey, which polls professional analysts and traders, just came out with the most bullish average forecasts in the entire history of the survey going back to the early 2000s. These are people whose careers depend on getting this right, and they're projecting massive continued gains. The forces driving this aren't short-term speculative flows that can reverse overnight. China's export policy is locked in through at least 2027. The industrial demand trends are multi-year, if not decade-long, megatrends. The supply deficit is structural. This isn't like a meme stock rally that can evaporate when sentiment shifts. This is fundamental supply and demand economics playing out in a critical industrial and monetary metal. Could there be pullbacks? Absolutely. Silver is volatile. We could see a correction to $70 or $60 at some point, especially if there's profit taking or if broader markets sell off. But in a multi-year bull market, those pullbacks are buying opportunities, not reasons to sell. If you believe in the long-term thesis, you want to use dips to add to positions, not panic and sell at the bottom. For those of you still holding 100% physical silver, I'm not saying you need to do exactly what I did. Everyone's situation is different, everyone's risk tolerance is different, and everyone's investment goals are different. What I am saying is, take a serious look at the opportunity in mining stocks. Do your own research, understand the leverage they provide, understand the risks, and decide what allocation makes sense for you. Maybe you're comfortable moving 50% into miners and keeping 50% physical. Maybe you only want to move 20% and keep the bulk in physical. That's fine. The point is to recognize that if we're truly in the early stages of a historic bull market in silver, the mining stocks are where you can potentially generate life-changing returns. Physical silver will do well, but miners can do exponentially better if you pick the right ones and if the fundamentals play out the way I believe they will. Before I wrap up, let me leave you with one final thought. The best investments are often the ones that seem crazy or risky when you make them, but obvious in hindsight. In 2020, if someone told you Bitcoin would go from $10,000 to over $60,000, most people would have said that's impossible. If someone told you in early 2025 that silver would gain 150% in 1 year, most people would have laughed. But it happened. And the people who recognized the opportunity early and had the courage to act on it are the ones who made generational wealth. I believe we're at one of those moments right now with silver and silver mining stocks. The fundamentals are as strong as I've ever seen them. The supply-demand imbalance is real and getting worse. The catalysts are in place. China's export restrictions, industrial demand acceleration, investment flows turning positive, and the macro backdrop of inflation concerns, currency debasement, and geopolitical uncertainty all support higher precious metals prices. This is my conviction trade for 2026 and beyond. I sold 80% of my physical silver because I believe the mining stocks will deliver multiples of what the physical metal can deliver. I'm confident in this decision because I've done the research, I understand the risks, and I believe the reward potential far outweighs those risks. Time will tell if I'm right, but I'm comfortable with the position I've taken. If you found this useful, let me know in the comments. Tell me what you think about this strategy. Are you considering making a similar move, or are you staying 100% physical? What mining stocks are you looking at? I read every comment and I love hearing your perspectives. And if you're not already subscribed, make sure to subscribe and hit that notification bell because I'll be doing regular updates on the silver market and my mining stock positions as this bull market unfolds. Thanks for watching, and I'll see you in the next one.